Welcome everybody today. My name is Carl Holman. I'm the Director of Communications here at A&D Mortgage. So I want to welcome you all to today's webinar. We're joined by Rick Sharga, and we'll be talking today about the fall housing market and what trends we think we're going to see happening and where the opportunities are for our broker partners and other guests that are watching to expand their business. A couple quick housekeeping rules before I make the introductions. So very quickly, all of your cameras and microphones are muted. And we would ask you if you could also silence your cell phones and not take business calls so you can maximize the opportunity to get the information here. And then if you have questions, you can either type them into the chat or the Q&A panel, and we'll get to them most likely at the end of the presentation because we've got quite a number of charts and slides to look at. And then I'll preempt the first and usually the most popular question, which is for those people who are late or just aren't. We do record this, so you'll get a copy of both the presentation and a copy of the recording, typically within about 24 hours, depending on how quickly the system processes the video. With that, let me do a quick introduction of Rick Sharga. For those people who don't know, Rick, he is one of the most respected, quoted, cited real estate and mortgage experts in the country. He's got an extensive background of, we'll be generous, say 20 plus years in the industry. And I've worked with him previously at a prior lending institution, so I've come to respect him greatly, and many of our trade publications have speak to him at least once a week, and he's doing tons of webinars and seminars. So we're very lucky to have him. Did I miss anything, Rick?
Nothing important.
Nothing important. Okay, so with that, we're going to just kind of have a conversation about where we think things are going. Before that, we'll just quickly introduce ourselves. Again, I'm Carl Holman, Director of Communications. I've been doing marketing and PR for, again, over 20 years, and about 10 or more in the housing and real estate industries, mostly with emphasis in mortgage, particularly now in B2B. I've been here about 2 years. A&D Mortgage is one of the top non-QM lenders in the country. We are predominantly wholesale, so dealing directly with brokers. And we've been operating since 2005, and we partner up with a company called Imperial Fund. They are our partner to sell off loans to the secondary markets, and they also back us that allows us to originate and develop our own proprietary guidelines, so it allows us to take a little more flexibility in who we can do loans to. And we do both a mix of conventional government and non-QM. So and in terms of where we are, we're pretty much nationwide, as you can tell. And we're licensed you're able to do business loans without a license in 40 states with us. So there's lots of opportunities for you folks to do business with us. And we also do correspondent lending and direct to consumer retail lending. But again, predominantly wholesale. So with that, Rick, I'll turn it over to Rick. And the first sort of major area we're going to cover will be the general economy. Then we'll look at the housing market, look at trends happening with rentals, because that's some of your direct competition in the purchase market. What's going on with investors and investment loans, foreclosures, and then we'll kind of close out with our thoughts where we think things are and where the opportunities are. So Rick, high level, let's talk about economic indicators and sort of where you see things going and where we're at currently.
Thanks, Carl. Why don't you head, there we go.
Yep.
So the basic metric that most economists use to look at the health of the U.S. economy is the GDP, the gross domestic product. And for all the conversations we've been hearing about or reading about in the media about a looming recession, the GDP continues to chug along at a pretty healthy pace. The second quarter number, the original estimate was about a 2.4 rate of growth. It was recently downgraded to 2.1, but it's still a higher number than what a lot of economists had projected, and certainly a higher number than maybe the Federal Reserve had in mind. But bottom line here is that the economy overall continues to be fairly healthy and fairly positive. Before we move into the next series of slides, I should point out, for anybody who's not aware of this, the GDP in the United States is very dependent on the health of the consumer. Consumer spending makes up roughly 2/3 of the GDP. There are other components like business spending and government spending and trade and so forth and so on. But generally speaking, if you see a healthy growth rate in our gross domestic product, it suggests that the consumer is doing pretty well, and that's what we're seeing today. So if you move a little bit forward, one of the reasons for that is that unemployment is still very, very low. And as we go through these slides, I don't want to be Debbie Downer here, but each of these slides, each of these components we're going to be looking at by itself looks pretty positive. But we are seeing the possibility of some storm clouds on the horizon. When you look at this slide and a couple other slides as we go through this, there are some red flags to point out. So unemployment is still very, very low. Historically speaking, I think the last reading was 3.8% unemployment. Continuing unemployment, which is the dotted line you're looking at here, continues to be very, very low. Historically speaking, that's okay, good. Historically speaking, if you're at 5% unemployment, most economists will tell you you're pretty much fully employed. But the fact that the numbers are trickling up just a little bit is something to keep our eye on. There are still more jobs available, and there are people looking for work. Last count, there were about 8.8 million job openings and about 6 million people looking for work, and that's driving wage growth up. And that's actually, if you can go back a slide, Carl, we see both hourly wages going up to a fairly high level, about $29 an hour. And you see wage growth going up at about a little under 5%. But again, this is one of those that if you look at it by itself, it doesn't look too bad. But in combination with some of the other slides, you can see that wage growth dipped from over 5% year over year to down a little bit below 5% year over year. So again, it's a trend line that we'll keep our eye on going forward. Wage growth is still outpacing inflation. And for the first time in well over a decade, wage growth is actually going up faster than home prices. But again, we'll have to keep our eye on this number to see if it continues to trend down. Go ahead to the next slide, Carl. This is one of the first red flags to point out to you. And there's two things about this chart. The blue bars you're looking at are consumer confidence readings from the University of Michigan Consumer Sentiment Survey that they put out pretty much every month. And from the time the pandemic hit back in 2020, we've seen consumer confidence weaken a bit. It started to come back, and consumer spending historically has gone hand in hand with consumer confidence. So the more confident the consumer is, the more they spend. Those two things are pretty much disconnected now, and we're seeing consumer spending continue to go up at a time where consumer confidence has now come down 2 months in a row. And is down near the low end of the readings historically. So one of the red flags here is consumer spending could start to get dragged down by consumer confidence, and we could kind of worry ourselves into a recession if we're not careful. Go ahead to the next slide, Carl. Consumer spending also is a bit of a red flag based on this. Last quarter was the first quarter in U.S. history where credit card use went over $1 trillion for the first time. That's a lot of money. No matter what inflation tells you, $1 trillion is still quite a bit of money. The worry here is that we may have people tapping into their credit cards to make ends meet. So this may not be discretionary spending. This could be people actually getting into their credit cards to pay for food and fuel and things like that. In a high cost of living environment, which is what we're in right now, a lot of households at the median income level or lower are spending a very high percentage of their income on things, necessities like food, gasoline, energy. And the worry here is that they might be starting to put some of this on their credit cards at a time when credit card interest rates are the highest they've been in decades. So it's not a good combination. Again, it's something we'll be watching pretty closely. Did you want to say something, Carl?
No, no, I'm trying to keep it on mute. I unfortunately have things happening outside my domicile.
Well, then let's go to the next chart, which shows another red flag corollary to the last one. We've seen personal savings rates come down to nearly historically low levels. So during the pandemic, you see how savings spiked, and that was because the government was sending out stimulus checks to everybody. People were saving that money. There really wasn't a lot they could buy because all the stores were closed. Since we've come out of that, savings rates have declined first back to normal levels, and now to really historically low levels. And I've read some research recently which indicates that the average household actually has more credit card debt than they have savings. And again, this is one of those red flag indicators. It suggests economically stressed households may be tapping into their savings in order to make ends meet. So, excuse me, that combination of continuing high consumer spending, a lot of credit card use, low savings rates are all indicators that we could be looking at an economic issue coming in the months ahead. And this is an early warning sign. And it's kind of interesting, Carl, because you and I both, having been in the mortgage industry for a long time, we're seeing delinquencies in consumer loans, but not in mortgages. And we'll get into mortgage delinquencies a little later. Mortgage delinquency rates are actually going down. But other loans, general consumer loans, credit cards, auto loans, we are seeing early stage delinquencies come up. Keep in mind, this is all being tracked at a time when people aren't making payments on their student loans, or at least aren't required to make payments on the student loans.
That's true. That'll start back up soon.
That'll start back up, I believe, next month. And when that happens, we'll have to see what happens with delinquency rates in that category, but whether or not it has an impact on these other categories. By the way, this is a complete reversal from what we saw during the Great Recession. During that period of time, people were making their auto loan payments and credit card loan payments, but they weren't making their mortgage payments. A big difference is that there's about $27 trillion in homeowner equity today. Whereas if you go back to the Great Recession, about a third of all homeowners were actually in a negative equity position. They were underwater on their loans. So in this case, I believe they're making their mortgage payments to protect that equity. And we do know there was a lot of subprime lending going on in the auto industry over the last couple of years. And those loans seem to be the ones that are going sideways. The good news, such as it is, if you look at these delinquency rates, is that it tends to be early stage delinquencies. So people are missing a month on their credit card payment, but catching back up after that. So we're not seeing these rates go seriously delinquent, but it is something, again, that's a little bit of a red flag.
But kind of what it could be a good opportunity for is, though, if they're missing these payments, they could qualify for, they may get DQ'd for conventional mortgages, right? And likely better off with non-QM. And
they might be better off with non-QM. And this is also a refi opportunity for mortgage brokers and loan officers.
Cash outs.
Yeah, if cash out refis to pay down some of these higher debts or higher cost debts. Of course, that becomes problematic depending on how delinquent the borrower is, because their FICO score may have taken a hit in the process. But for lenders who have that flexibility of non-QM products, there is an opportunity here.
Okay. Ooh, one of your favorite topics.
Yeah. So we know the Fed is really hell-bent on getting inflation under control, and for good reason. That dotted line you see there is the rate of inflation, and it peaked over 9% not too long ago. the Fed's tool to try and combat inflation is to raise the interest on the Fed funds rate, and that's the rate that the banks charge each other for overnight loans. And that tends to slow down the economy. And as you can see, for a number of months, the rate of inflation was coming down. Now we've had 2 consecutive reports where it's ticked up slightly. So anybody hoping that the Federal Reserve was going to, reverse course and start to drop the Fed funds rate, probably not likely to happen anytime soon. But I wanted to share with the viewers today how unusual the Federal Reserve's action has been this time. The shaded areas on this chart are where the Fed raised the Fed funds rate. And if you look at the last time they did this back in 2016, you can see that they did it on a step-by-step basis, very kind of slowly and gradually, waiting to see what kind of results transpired. And then, gradually they could reduce the Fed funds rate as inflation was under control. In this case, they admitted that they waited too long to get started. They underestimated how high inflation was going to get, and they underestimated how sticky it was going to be. I don't know if you remember, but a year or so ago, all we heard from the administration and Federal Reserve Chairman Powell was that inflation was transitory. It wouldn't be here that long.
Mm-hmm.
And either they misinterpreted that or they changed the definition of transitory from the one I grew up with.
Yeah.
But you can see how rapidly and how highly they've raised the Fed funds rate on the right-hand side of this chart.
Yeah.
This is the highest they've raised it
quickly.
Over 40 years, and they've never raised it this quickly. So it's a very unprecedented time. It does seem to be having its impact, but we're not down to that 2% a year inflation level that the Fed has targeted. So we're likely to be in this high interest rate environment for the foreseeable future.
Oh, don't say foreseeable future. People wanting to have an end year in mind, preferably
Well,
2020, preferably 2023.
No, not going to happen in 2020. Well, look, we'll keep going through this, and we'll share some more thoughts as we go. The market didn't react. Let me take that back. The market reacted immediately to what the Fed was doing. The financial markets were in turmoil. It's why mortgage rates have risen as high as they have, as quickly as they have. But the bonds market didn't necessarily react as quickly as you might have expected. When Chairman Powell about a month ago kind of doubled down on the notion that we're probably going to see the Fed funds rate stay higher for longer, the bond market finally started to react. And we've seen the yield on a 10-year Treasury note rise pretty significantly. It's trading at almost 4.6% today, those yields.
Mm-hmm.
That's relevant to us because the 30-year fixed rate mortgage tends to be based loosely on these 10-year Treasury yields. So as these yields go up, it's very likely we see mortgage rates go up. So if you go to the next slide, one of the other things that we're seeing in this market, and I apologize, this is a little bit of an eye test, but there's usually a spread between that 10-year yield that I just talked about and 30-year rates. And that spread is usually about 1.5 to 2 points. So in today's market with a 4.6% yield, we'd be looking at a mortgage rate of probably 6.6%. And in fact, we're looking at rates that are a full point higher than that in most cases. So that gap between yields and mortgage rates is because the market is pricing in some risk and volatility because they're not really sure what the Fed's going to do.
Yeah, because I mean, your graphs pretty much align on top of each other pretty well, except
for right now.
Except for our quirky time that we live in now.
And so what that's the net effect of that is we're looking at the highest mortgage rates we've had in over 2 decades. As much as I was one of the people early on saying we could see mortgage rates come down into the low 6s or even the high 5s by the end of the year earlier, that clearly was wrong. And what I didn't anticipate was the bond market going sideways on us. Lawrence Yun, who's the chief economist at the National Association of Realtors, recently said he wouldn't be surprised if mortgage rates touched 8% before they started coming down, but he did believe that they would start to come down later this year. And for what it's worth, for everybody who's wondering about this, every time in history that the Fed has gone through one of these rate hike cycles and announced that they were done, we've seen mortgage rates start to come down. So even if the Fed has one more rate hike in them this year, which most economists believe is likely to happen maybe in November, once they acknowledge that they're done raising, we should start to see mortgage rates settle down. And that chart we just looked at shows you that just to get back, if we got back to normal spreads between the 10-year yields and mortgage rates, we could see rates come down a full point. So there's a lot of moving parts here, but I do believe we are either at or near our mortgage price peak this year, and that hopefully we'll start to see them come down slowly and gradually, but come down later this year.
Okay. Let's talk about purchase loans.
Yeah, not surprisingly, since interest rates are as high as they are, we've seen purchase loan activity come down pretty significantly, down about 30% from a year ago. And about this time last year was when rates started to skyrocket. Really important for people to keep this in perspective. Last year was the first time in the history of the country where mortgage rates doubled in a calendar year. And they didn't just double in a calendar year, but they doubled in the space of a few months. So somebody who'd been looking to buy a house a couple of months earlier was suddenly looking at a monthly mortgage payment that was 45 to 60% higher than it would have been if they'd acted earlier in the year. And it's been a real challenge for buyers to try and compensate for that. So on the purchase loan side, again, not a huge surprise. We've seen a pretty steady decline. The little spike that we saw earlier this year shows you how rate sensitive the market is, because rates at that point, went all the way down to somewhere around 6.5%. We started to see a lot of buying activity. But this is one of the predictors that we look at in terms of trying to figure out what's going on in housing, and it's not spelling much in the way of a robust market. If you jump ahead, what we're also seeing is that overall origination activity is continuing to fall. So the red line you're looking at there is refinance activity, and you can see that pretty much fell through the floor as interest rates rose last year. I believe the last number I saw from the Mortgage Bankers Association, that's who this data is from, said that mortgage refinance activity was probably off by about 80% from peak, and is not projected to come back in a meaningful way really until at least 2025. And that's because it will take a while for these new interest rates to get into the market. And as rates come down a little bit, then it'll make more sense for people to get into those rate-based refis.
Yep. But today's purchase is tomorrow's refi. So
yeah, and again, most economists that I talk to or follow believe that we will see rates back in the fives at the latest in late 2024, early 2025. So it's going to be a slow and gradual decline in mortgage rates starting the end of this year and going all through next year as well.
Okay. So we've talked about a lot of different aspects. So you want to connect the dots and sort of come to the summation of what you see happening just from a general economic standpoint. Is it looking pretty grim? Are we looking like we're going to turn a corner?
It's not grim, Carl, but it's not rosy either. I think the best way I can describe this is the historic precedents tell me that a recession is still more likely than not. We talked about the Fed raising rates as high as they did. 8 of the last 11 times they've done that, they've overcorrected and steered us into a recession. Seems more likely than not they've already overcorrected this time. And we didn't talk about the yield curve inversion, but we've seen the rates, the yields paid on a short-term investment, the 2-year bond, go higher than a longer-term investment like a 10-year treasury. And every time that's happened, the last 7 times that we've seen that happen, a recession has followed. So I'm of the group that thinks we will probably see a recession sometime in 2024. But because all the other aspects of the economy are still pretty strong, it's likely to be a fairly short and fairly mild recession. And it doesn't seem like we'll get unemployment much above 4.5 or 5%. So it shouldn't have a huge impact either on our industry or the housing market.
Okay. All right, well, let's shift gears and talk about the housing market itself and what we're looking at for starts and existing home sales and available inventory, and see where we are looking for the rest of the year.
So, not surprisingly, as we see purchase loan applications go down, pending home sales are going down too on a year-over-year basis. And this is one of the two sort of forward-looking indices that are out there. The purchase loan is one. Somebody's applying for a loan, they're likely to be buying a house. And then pending sales show contracts that have been signed, but the transaction hasn't formally occurred yet. This one comes out from the National Association of Realtors. So this is another one that's suggesting that home sales are not going to be particularly robust going forward. And if you jump ahead, that's exactly what the data is showing us. So August was the 24th consecutive month where existing home sales were lower than they were the year before. Last year's sales, the blue lines you're looking at, it had a pattern I've never seen before. So it may have happened sometime in the past, but I'm not familiar with it. January was the highest month in terms of existing home sales last year, and every subsequent month was lower than the month before. I've never seen that happen. And what that means is we basically wiped out the spring and summer selling season when we usually see home sales go up.
Yep.
We've had a similar pattern this year, except for January. January was the lowest month of the year. It picked up a little bit in February, but we've been lower every month since February on a month-over-month basis. And again, 24 consecutive months of declines. So when we started this year, my forecast was that we'd probably see about 4.3 million existing homes sold. That'd be down from about 5.2 million last year and about 6.1 million the year before. So pretty significant declines, but I may have been too optimistic. Right now, the trends are showing that we are likely to come in at about 4 million flat, or maybe even slightly below 4 million, which would be the lowest number of existing homes sold since 2009, coming out of the recession. So a pretty weak housing market in terms of sales volume, mostly because of affordability, but also because of inventory, which we'll get to in a minute.
Yep. All right.
I also want to point out this is a very localized, regionalized housing market that we're dealing with right now. Everybody talks about how local a housing market, how local a thing the housing market is. This chart, which is from Realtor.com, shows a combination of sales activity and search activity. And a lot of the search activity is happening in the Midwest and the Northeast right now for some reason. In some cases, it's affordability. In some cases, it's just availability. But we are continuing to see a migration from some of the higher cost states to some of the lower cost states. And I think that has an impact here. But what's really important, whether you're an investor, a home buyer, a mortgage broker, a loan officer, is to understand what's going on in your local market. The same thing happening here, we're seeing in terms of prices, where if you're in coastal California, the Pacific Northwest, Boise, Austin, Phoenix, you're seeing price decreases from peak of double digits. On the other hand, if you're in the Southeast or most of the South, almost anywhere else in Texas other than Austin, you're still seeing prices go up on a year-over-year basis. So really, really important to be looking at things locally and almost not paying attention to what's going on in the national numbers. Carl, did we lose you? I'm going to jump in and share my screen. Okay, it looks like Carl might be back. Carl, you back?
Sorry. Yeah, sorry about that, folks. Get occasionally a little hiccup once in a while. Let me get the screen back up. Love my internet. All right, so we were last talking about the hot housing markets.
Yeah, let's move beyond there.
Okay.
And I talked about the other issue in the market being inventory.
Inventory.
And inventory is down 14% year over year. We're still below a 3-month supply. That's relevant because in a normal, balanced, healthy housing market, you're typically looking at about a 6-month supply of homes available for sale. We're down below 3 months, so we're less than half of where we would normally be, which suggests this continues to be a pretty strong seller's market. If you go back to 2005, 2006, kind of right before we hit the Great Recession, we had a 13-month supply of homes available for sale.
Yep.
So it was twice as much as the market could eat. And one of the reasons we're not seeing prices deteriorate is because there's simply not much supply available.
And that's
So,
mainly because the builders don't want to pay the existing interest rates on their loans.
well, this is great point, Carl. But this is actually about existing homes. So we'll get to new homes in a second.
Sorry, that's what I was pointing towards. All right.
This is from Altos Research. They actually track things on a weekly basis. And just to kind of show you, that red line is inventory for this year. And you can see the yellow line from last year. We're still down about 10% year over year, but we're down about 47% from 2019, which was probably the last normal year we had in the housing market. So just to kind of show you the issue we're dealing with. And by the way, I believe the numbers that we're seeing both from Altos and the NAR are a little bit artificially high. It's not necessarily that the inventory numbers are getting better, because new listings are actually off significantly year over year. What's happening is it's taking longer to sell the properties once they come onto the market. But if you go to the next slide, we'll show you the reason for new listings being lower. There's something that economists refer to as rate lock. And that's what happens when a homeowner has a mortgage rate that's significantly lower than current market rates. And this is data from Freddie Mac and their national mortgage database. 93% of homeowners who have a mortgage loan have a rate at or below 6%. And 2/3 of homeowners with a mortgage rate have a rate at or below 4%. So think about the math. If you're a homeowner with a 3.5% mortgage, and you sell your home and buy another home at exactly the same price as the one you just sold, your mortgage payment just doubled monthly. Most people just can't handle that kind of financial hit. So until we see mortgage rates come down, most of the existing homeowners out there aren't going to list their property unless they need to. And it's just a market reality. So there will always be some people who have to move. Maybe they're downsizing because they're retired. Maybe they're upsizing because they've had kids or they got married. But by and large, we're going to see housing inventory levels of existing homes available for sale continue to be low until we see some of the mortgage rates start to come down. Now, you were talking about new homes. Oh, sorry, price appreciation.
Yeah.
So we still have demographically driven demand. So we have the highest number of young adults between the ages of 25 and 34 in U.S. history. They would prefer to be homeowners. If they can't buy, they will rent, but they prefer to be homeowners, and they are coming of age. 33 last year was the average age of a first-time buyer. So as these folks look for homes, and there's little inventory available, we're still seeing multiple bids on properties listed for sale. So again, very strong seller's market. We saw home price appreciation come down, but one of the urban legends that has continued in the mortgage industry and the housing market is that as mortgage rates go up, home prices come down. And except in extreme cases, that actually isn't the case. If you go back and look at things historically, as mortgage rates go up, home prices continue to go up, but more slowly. So home price appreciation comes down. We actually went into negative numbers earlier this year in terms of home prices, but in June, they turned the corner and started to go back up. So we've now had 3 consecutive months of home prices increasing on a month-over-month basis. And in fact, if you look at median home sales prices, last month, they were at $407,000, third consecutive month of being over $400,000. And are actually up slightly from a year ago, same time. Keep that in mind as we move ahead, because we'll talk about the difference between existing home prices and new home prices. But if you go to the next slide, you'll see that FHFA, who controls Fannie Mae and Freddie Mac, so these are all your conventional loans, they're showing even stronger price growth on a year-over-year basis, over 3% nationally. Only two market sectors across the country are showing year-over-year declines. Two areas that I talked about a little earlier, the Pacific region and the mountain region, but everywhere else is actually net positive. And these are, again, conventional loans, which comprise the bulk of lending activity out there. So we are seeing prices on the existing home side actually go up a little bit. Take a look at new home sales, they're actually doing a little better. Yeah, and this is because builders are offering incentives. So early on, forecast for new home sales was probably somewhere between 600, 625,000. Right now, it looks like we're trending at about 675,000. And we would probably sell more if the builders would build more. But I mentioned they're offering incentives. If you go to the next slide, one of the incentives is lower prices. So while existing home prices are going up, we've seen median prices on new home sales come down pretty significantly, about 16.4% from the peak. Now, that doesn't mean they're discounting properties they built a year ago. What it does mean is that they're building smaller homes, or they're building somewhat less expensive homes. They're also offering other incentives, upgrades in some cases. They're coming to closing with cash, which they're using to buy points and pay down mortgage rates. But bottom line is they are dealing. And if you're a Toll Brothers or a Pulte Homes or somebody else out there who's a builder, you have 3 or 4 properties available at the end of a development that are vacant. They're costing you money every month. So you're incented to sell those properties, and you'll do what you can to get them off your books, recapitalize, and move on to your next project. So fundamental difference between new home sales and existing home sales is that willingness of the builders to negotiate.
Yep. And where do you see builder confidence at now? Do you feel they think
Builder confidence is actually down. It had a few months there where they were feeling pretty good about things, but the last couple of months they've been going down consecutively, and they are seeing less buying activity. They are seeing less foot traffic in the homes that they're building, and they have some economic concerns as well.
which takes us to the next one.
They are bullish on the future, not as bullish on the present. That's what this chart is kind of indicating. So the blue line you're looking at here is the number of months of inventory of properties under construction. The red line is the months of inventory of completed new homes, and the gray line you're looking at basically is permits. So these are lots that the builder has secured, and that number has been going up. So we know builders are bullish on what's ahead. The red line, about a year ago, we were in a really weird position where we had the highest number of homes under construction in history and the lowest number of completed homes in history. And this data goes back about 50 years. A lot of that was due to supply chain delays and due to labor shortages. The builders have been working through that glut of homes that they started but didn't finish. And the reason that the completed numbers aren't coming up a little bit more quickly is that the builders are selling a lot of these properties before they're done. So the buyers are coming in, the properties halfway, 2/3 of the way done, they buy them on spec. And so again, we're not seeing a ton of new stuff happening. Housing starts in the most recent reports were actually down about 12% year over year on the single family side. So the builders got caught during the Great Recession with a lot of inventory that they built once the buyers had stopped buying. And then they underbuilt really for better part of a decade. They're not overcorrecting now. They're being very judicious about how much they bring to market. So we're not going to build our way out of the housing shortage in the next couple of years for sure. And as if all this weren't enough, there's something.
Let's talk about catastrophes.
Yes, let's talk about catastrophes. So yeah, we've had an increase in what the pundits refer to as extreme weather events, whether that's hurricanes in Florida and the Gulf states, or wildfires in California, or hailstorms, severe hailstorms in Texas. There was just one yesterday, I think in Dallas, with baseball-sized hail, which is kind of scary. But we are seeing weather events, and we're seeing insurance costs skyrocket in some of these states, double, triple premiums from what homeowners been paying a year before, and in some cases, an inability to get insurance at all, as some of the major insurers are pulling out of the states. So
Yep.
this is some information from John Burns Research. They do a good job on what's going on with builders and the housing market, but we are already seeing an impact of sales slowing down because of insurance issues, and it's something for the market to keep in mind as we move forward. From a lending perspective, really important to be looking at the markets where you're making these loans, because you obviously don't want to be insuring a house that can't be insured, at least unless the buyer has sufficient means to self-insure. And you also have to keep in mind that the DTI ratio is going to be impacted a bit by the premiums that this borrower needs to pay. I'm hearing from mortgage servicers, anecdotally, you don't have anything quantifiable, but they're seeing delinquencies, and when they contact the borrower, they're finding that the borrower got their annual premium from the insurance company and had to make a decision that month about either paying the mortgage or paying the insurance premium. So that month they elected to pay the insurance premium, and over the next couple of months they catch up on their mortgage. But it's a real world circumstance that's starting to happen now, both for existing homeowners and for new buyers.
Okay. All right, and that kind of covers the housing market as a whole. Do you want to kind of summarize what you see happening?
I believe what we're going to see in 2023 is pretty much what you're going to see for the next year or two coming out of this year, which is we will continue to see a relatively weak sales volume of existing homes in particular. Stable prices going up, but going up moderately, 3-4% a year. New home market a little bit more variable, a little bit more volatile, but the builders will sell the inventory they bring to market. So we could see those sales numbers come up a little bit, but I don't see a housing price crash. We could see localized market corrections. We're going to continue to see migration from higher price markets to lower price markets, which will have the impact of raising prices in some of those areas. So it's going to be an interesting couple of years, but I don't see a crash happening in the housing market. I see really instead kind of a boring, fairly slow recovery over the next couple of years.
Yeah, and affordability will probably remain the number one issue for most of the rest of the year.
Affordability is a real problem right now. If you're in a state like California, I believe the last number I saw was something like 16% of Californians can afford to buy a median priced home. Just a ridiculously low number. But I will give you some glimmers of hope for the future. Mortgage rates will come down, and that will help. Home price appreciation has slowed down below wage growth, and wages continue to rise. So over time, those three things in combination will make affordability feel a little bit better, but it's going to be a gradual process.
And that kind of hits on our next customer base, which would be the renters. So let's take a quick dive into the rental market and see what you're seeing.
Well, rent prices had gone to astronomical levels over the last couple of years as well. Asking rents on new leases went up over 15% in 2022, which is just off the charts, and you can see that from this chart. In a normal market, asking rents go up somewhere between 1 and 5%. So 15% was just unheard of. As we are seeing more apartments come to market, and there are estimates that we could see as many as 1 million apartment units come online this year. That's helping to provide enough supply that renters have options. Now, again, probably somewhere between 20 and 25% of people who would have bought a house have decided to wait for market conditions to improve, so they're renting. But you can see that those asking rents have come down pretty significantly. We're still marginally positive in multifamily rents. Single family rents in many markets have actually come down a little bit year over year. So right now, it in many markets, it's actually much more affordable to rent than it is to try and buy a house.
Interesting. And where do you see the hot markets? What's happening there?
Well, it's interesting. We're seeing most of the rent growth in kind of secondary and tertiary markets. You're not seeing the New Yorks and the Los Angeleses of the world, seeing big rent growth. But I mentioned people moving into markets that are lower priced. You can see the Nebraskas and the North Dakotas and the Mississippis, and some of those Wisconsins and Texases are some of the markets where we're seeing rent prices go up. On the other hand, interestingly, a lot of the cuts to rent prices, again, this is asking rent, are in some of the same markets we're seeing home prices fall. Markets that had been soaring in terms of home prices were also soaring in terms of rent prices. So you look at a Boise, Idaho, you look at an Austin, a Phoenix, a Las Vegas. These are all markets where we saw prices soar over the last few years. And we're seeing both home prices and rental prices coming down in those markets as well.
Interesting. And what about vacancies? We seeing anything happen
Well,
there?
even vacancies were starting. I mean, so this is occupancy, which is the opposite of vacancy, but you get the idea. And we saw occupancy rates last year go to the highest they've ever been, almost 98% occupancy rates, which means that a little over 2% of apartments were unoccupied. Now we're back down to normal levels, which is somewhere between 94 and 95% occupancy. And that's really interesting because, as I mentioned, we've seen a lot of apartments come online this year. So, vacancy rates have stabilized. We are seeing, I think, a little bit more demand, and that's balancing out the new apartment construction that's coming online this year. So, again, unless we see occupancy rates dip significantly lower, not likely that we're going to see rent prices go negative.
So what's the overall crystal ball forecast you see for the renters becoming owners?
Rent market, rental property owners, I think, are in good shape. Demographically speaking, we should see demand continue to improve over the next couple of years. Right behind those young adults I mentioned are a whole bunch of people from Gen Z who will be following right behind them and will likely be renters before they're homeowners. So I think the multifamily market's in pretty good shape for the next couple of years. And I think the affordability issues in the owner-occupied purchase market are going to provide opportunities for rental property owners who own single-family rental units, houses. It stands to reason that if a family wanted to buy a house, they'd probably rather rent a house than rent an apartment. They may need more room. They may want to be in a certain school district. So I do think there's opportunities for any of your borrowers who are looking for those kind of properties.
Good job. Well, and then if you're not going to purchase one, you're not going to rent one, there's always the possibility that you could turn to real estate as an investment. So let's talk about what's going on with the investment market.
Yeah, why don't we do that? Investors, and this is from CoreLogic. According to their most recent data, about 26% of residential home purchases in June were made by investors. And I believe this number is actually low. And I don't say that because I'm questioning CoreLogic's data. It's just what they count. So CoreLogic in their methodology suggests that they count as an investor purchase anytime the buying entity has a corporate name. So it's an LLC, an LP, a corp, something like that. And that's what they count as investor purchases. We all know that if you go to the next slide, the overwhelming majority of investor purchases are actually made by small and mid-sized investors. They don't always have a corporate entity in their name. So what we're seeing is that about 90% of those investor purchases are by the smallest of the investors and the small to mid-sized investors. The institutional folks have really kind of slowed down. They're in the 10% range, and they're keeping their powder dry, I believe, and they're waiting for markets to be a little more favorable for the kind of properties they're looking to buy. But again, these individual investors own collectively about 90% of the single-family rental units out there. The biggest of the big institutions collectively own about 3%, and then there's a middle tier that picks up the balance. But we are seeing a relatively high percentage of investor purchases, and one of the reasons for that is there's less competition, not just from the big guys, but also from traditional home buyers who are having affordability issues.
Interesting.
We're also seeing a little bit more activity by investors who are buying to rent, and a little bit less activity from investors who are the fix and flip buyers. We saw the last quarter of fix and flip activity. The numbers were up slightly on a quarter-over-quarter basis, but we're still dealing with three of the weakest quarters we've seen in the past few years. There were something like 84,000 flips last quarter, up from 70-some thousand. But again, pretty weak numbers, relatively speaking. So the flippers are challenged by market conditions, just as traditional homeowners are. Financing costs being higher, affordability being an issue for people that would buy the properties they're looking to flip. And then, candidly, their repair costs have gone up as materials costs and labor costs have gone up. So I think if you're looking at overall investor activity, would not surprise me to continue to see between 25 and 30% of sales going to investors, but they're skewed a little bit more right now toward renters or toward investors who are buying properties to rent rather than buying properties to flip.
Interesting. So, unfortunately, with the decline in fix and flip activity, there'll probably be fewer shows now on HGTV with all the home renovation shows they have.
That may be a good thing, actually.
Yeah, good thing they settled the writers' strike. There'll be content that they can have on their shows.
There you go.
Well, let's talk the worst case scenario for buyers, which is, or for existing homeowners, which is what happens if they aren't paying their mortgage in turbulent times, and that's delinquencies and foreclosures. So let's see if things look grim there, if there's some hope.
I mentioned earlier that loan delinquency rates for consumers are going up in most categories. Interestingly, mortgage loans are the exception to the rule, and we are near the historic low levels of mortgage delinquencies as of the end of the second quarter, according to the Mortgage Bankers Association. Mortgage delinquencies overall were 3.37%. In a normal market, a delinquency rate somewhere between 4 and 5%. And you can see how far down it's come since it peaked over 8%. And that was right after the pandemic was declared and the government shutdown happened. And you guys are all familiar with the forbearance program that the government put in place as part of the CARES Act. The primary reason that delinquencies went as high as they did back then was because people took advantage and moved into that forbearance program. So a borrower was marked as delinquent here, even though they weren't being reported delinquent to the credit bureaus. And over the course of that forbearance program, 8.5 million borrowers entered the program. And at some point, almost all of them wound up in these delinquency numbers. But as they've exited the program, you can see the delinquency numbers have pretty consistently come down. We had a little bit of a spike in the first quarter of this year. That's not terribly abnormal from a seasonality perspective. But you can see the seriously delinquent numbers, the green bar, are lower than they were actually prior to the pandemic. So we've had a good run in terms of mortgage delinquencies, and that's across the board. By the way, there's a very strong correlation between unemployment rates and mortgage delinquency rates. And when this snapshot was taken by the MBA, unemployment rates were about 3.5%. So you look at 3.5 versus 3.4, that's about as close as it can get. And if you're looking for a predictor, watch what unemployment rates do, and we'll see what happens to mortgage delinquencies. But mortgage delinquencies tend to lead to foreclosures. In a normal market, about 1 to 1.5% of loans are in foreclosure. In today's market, again, according to the MBA, about 0.5% of loans are in foreclosure. Just remarkably low numbers. And about 60% of the numbers we were seeing in 2019 prior to the pandemic. I should point out, just to keep things in context, that 2019 was not a particularly busy year in terms of foreclosures either. So since the Great Recession, lenders have taken on much less risk. Even non-QM loans have a lot of sort of risk prevention functionality built into them. And we're not seeing the kind of risk layering that we saw leading into the Great Recession, where you take somebody with a low FICO score, a zero down payment, no cash reserves, and no job history. the famous ninja loans. And you're not seeing that anymore. So even a borrower with a low FICO score very often has a lower LTV, or a higher down payment, or a lower debt to income ratio. But again, a lot of the risk came out of the lending market, and because of that, the loan quality was very strong, and delinquency and foreclosure rates were very low. Foreclosure starts are actually a little bit closer than overall foreclosure activity. And what I mean by that is, if you look at strictly foreclosure starts, they're back to about 80% of pre-pandemic levels. But the percentage of loans going to auction is lower, and the percentage of loans that are being repossessed is lower. So the overall foreclosure activity isn't quite there. One of the reasons we're not seeing a spike in foreclosures is that borrowers have an enormous amount of equity. I mentioned earlier, homeowners across the board have about $27 trillion in equity. Even borrowers in foreclosure, 92% of them have positive equity, and a lot of them have a lot of equity. If you break these numbers down further, about 88% of borrowers in foreclosure have at least 20% equity, which means they have a definite incentive to try and protect that equity rather than lose everything to a foreclosure sale. And this is very different than in the Great Recession, when just about everybody in foreclosure was underwater on their loan. And so in many cases, we're strategically defaulting. If you go to the next slide, you'll see the impact this is having on distressed property sales. And this is again kind of an important point. If you define distressed property sales as properties that are either sold during foreclosure, at a foreclosure sale, the auction, or by the bank after the property has been repossessed, we're seeing something that's very, very unusual right now. Almost 2/3 of properties that are distressed sales, 64%, are selling during the early stage of foreclosure, prior to the foreclosure auction. And that, again, is those borrowers with equity protecting the equity and selling their home prior to losing it at a foreclosure auction. The number of properties being sold at auction is a little lower than normal, but the sell-through rate is very, very high. So the properties that do get to auction are selling through at 60, sometimes 70% rates. All of that leaves far fewer properties for lenders to repossess and then resell as REO properties. So again, if you're working with investors, that's kind of the market that they have to deal with. They need to be looking upstream and working with those borrowers in the early stages of default.
All right. Let's covered that. So let's kind of step back, take a look at all the data we've looked at, and come up with your thoughts, and then let's see if we can find some good opportunities for brokers. And where can they go find some borrowers that we can make loans to?
Yeah, so we talked about the economy, the housing market, rental market, foreclosures. Just to kind of recap, we are seeing mixed signals in the economy. If you look at individual numbers, they still look pretty good, but the trends seem to be going in the wrong direction. So I believe a recession, a slight recession, a short recession, still a most likely outcome, probably early to mid next year, but not something that should throw the mortgage market or the housing market into turmoil or more turmoil. From the housing market, the mortgage industry perspective, highest mortgage rates we've seen in 23 years, very likely to keep home sales depressed for the time being. We'll probably wind up this year with about 4 million existing home sales and about 675,000 new home sales. The total number down pretty significantly from last year and the year before. New home prices are falling. Existing home prices appear to be recovering. And mortgage rates should start to decline once the Fed announces that it's stopped its rate hike cycle. I believe the rental market's in good shape. I think it's likely to grow, at least for the next year or two. Prices are stable. Vacancy rates are low, despite record levels of inventory coming online. That doesn't mean, by the way, that every market will be fine. We'll probably see some markets overbuilt. Some markets continue to be underbuilt. The market never gets it exactly right, but nationally speaking, things should be pretty stable. And I don't see either a home price crash or a foreclosure wave on the horizon, even if we do have a recession. There's just not enough supply, and there's too much demand and too much homeowner equity for those more dramatic negative events to occur. I think you're on mute.
Yeah, sorry about that. So for say the next 90 days, where do you see the opportunities for a broker? Is it investors? Is it
In, invest
specific
in,
sub-markets?
Investors are clearly going to be a major um, force in the residential home sales market, not just for the next 90 days, although we do see a lot of investors come to market in the last quarter because they realize that typically this is a slow time of year for traditional consumer home buyers. And there's a little bit less competition. So I would definitely be talking to investors. I think there's a real opportunity there. You might have some opportunistic home buyers out looking for those properties that do come to market. And we are seeing a little bit of an increase in inventory, relatively speaking, more so than we usually do this time of year. So there might be a few more properties to buy than what we saw earlier this year. The other aspect that's real world aspect right now is borrowers who have less than perfect qualifications for those conventional Fannie and Freddie loans need help, and I think there's an opportunity for non-QM lenders to work with those buyers in a market that's very competitive.
Yeah, so to do cash out refis or second liens.
Yeah,
I know HELOCs are.
We are seeing some HELOC activity, although it's actually down, believe it or not, on a year-over-year basis. But I think there's a cash out refi opportunity for specifically
popular,
for
but second liens are.
I think you froze there for a second, Carl. But I think the opportunity for cash out is particularly good for people with credit card debt. Credit card interest rates, can be 27, 28% because of how high the Fed funds rate is right now. And a borrower sitting on a significant amount of credit card debt may be very open to a refi to take some cash out and take care of that debt. Looks like Carl has lost his signal. I think we had covered pretty much what we wanted to cover today. So on behalf of Carl and A&D, I'm going to thank all of you for attending. A reminder that this has been recorded, and you should all be getting copies of this shortly. Looks like Carl is back.
Yeah, again, sorry.
I was getting ready to wrap up for you, Carl, and say goodbye to everyone.
Okay. Yeah, no, I got it. Yeah, well, we still have a couple more minutes, so we wanted to make sure we have time for questions. And then I'll do my quick little 30-second spiel. We do have Rick's contact information within the presentation, so we'll make sure everybody has that if they've got questions that we can't get to. Let's go ahead and I'll do a wrap up, and people can start putting their questions over either into the chat or the Q&A if they have any. We've been covering, I think, quite a bit, so we'll see where we go. For those of you who've stuck around, thank you. Just really quickly to remind you guys, we're here to be your partner for growth, as any of the brokers who may already be working with us know. But for those of you that don't, a couple of the points to emphasize is that we really believe in a simple, streamlined loan process. So we are doing everything we can to tweak our programs that are not GSE related so that we can get your loans closed quickly. We are clearly experts when it comes to non-QM, and if you see our tagline is the power of yes, so we definitely have a can-do attitude, and we're always trying to make sure we can do the best for your borrowers. Um, as I explained, our relationship with Imperial Fund allows us to do the next two things, which is to provide flexible underwriting and then be able to revisit loan products that are not GSE focused and adapt them to the current market so we can be a little more nimble with LTVs, max loan amounts, DTIs. So we're always responding to the market conditions to try to maximize the number of borrowers that the brokers can lend to. We definitely don't want to turn borrowers away. We want to make sure they have the opportunity to own a home. And then I'll just wrap up really quickly with a couple of webinars that we've got coming up. So we're going to be looking at profit and loss mortgages in mid-October. And then towards the end, we'll be looking at opportunities with foreign national clients. That's an area that we excel in. And then we're going to do a two-part series in November and December for those brokers that aren't terribly skilled with social media on how they can build their brand, identify what the best platforms are for them to be using. And then we'll look at a couple of the tools, predominantly ChatGPT with a couple of influencers. And help them craft marketing plans, emails, social media. So we're going to try to do a couple of practical how-to webinars that we think that's been an area where we've consistently heard from the broker community that they'd like some further assistance with. I think, a lot of the brokers are of my generation and maybe a little older and aren't as experienced with some of the new platforms. So we're turning to some experts that really know the stuff. So we encourage people to join up with that. Okay, so we've got a question from someone out there. So in your opinion, if someone has credit card debt and they're forecasting rates decreasing in 2024, would it be best rate-wise for them to either access their equity through a HELOC?
Carl, you might actually be better suited to answer that than I am, because I'm not sure what a HELOC rate would be compared to what a traditional cash out refi would be in today's market.
Yeah, and we don't offer HELOCs here at A&D Mortgage, but if the person can type their name in, I can get them in touch with an account executive, and we can take a look at where we think they could be tapping into that equity. We've got a lot of options available to them. Again, whether it's potentially a second lien or doing a true cash out refi.
And the answer to the question really would be, shop if you're looking at a HELOC, shop for that versus a cash out refi and see which rate looks better. Realistically, cash out refi probably has a longer payout, which might reduce monthly payments. On the other hand, you could wind up paying more in interest over the life of the loan. So it really depends on all those circumstances. But either is probably a better option than paying 27% credit card rate.
Good question. And that's the only question we've got. So again, if that person, whoever, because unfortunately they said it anonymously, if you want to email your question to marketing@admortgage.com, I can refer that over to an account executive and we can get back in touch with you to take a look a little more deeply. And then lastly, if you guys want to scan this QR code, we can go ahead and get you signed up for all of our different social media platforms. So I know we're a little bit over time, but I want to thank you, Rick, for as always, your in-depth knowledge and expertise and helping us identify for our brokers where our potential growth opportunities are. And thank you for those folks that stuck around through my two little internet hiccups. So with that, I want to close it out for the rest of the team. And again, we'll get copies of the presentation and the recording to those people who've registered for this again within about the next 24 hours. So with that, thank you very much, Mr. Sharga, and we will probably see you again in the spring for another take a look at the spring housing market.
Thanks, Carl.
All right. Thank you, sir.